Hey Dave, how you doing today?
I am doing great, Nick. How are you?
Throwing you for a loop today. Podcasting on a Monday.
Podcasting Monday. It doesn't feel right, but hey, it's summer. Every day should be Friday, right?
That's right. I love that. Can that be
That
our new
sounds like
company
something you would
motto?
say.
Our new
Yeah,
company motto.
yeah, yeah. I beat you to the punch.
Oh, love it. So we have interesting topic today. We've kind of talked about this, Dave, in a couple of our previous episodes. So some of this might be a little bit of a refresher, but we've never really kind of done a deep dive on this topic. And part of this came from an article that you read on the topic regarding target date funds.
Yeah, I read this article a month or so ago in Financial Planning News, and it kind of frustrated me the way they talked about target date funds.
Hmm.
And I guess, the way I would put it is they're a tool like any other investment, right?
Yep.
And if used correctly, they can be a very good tool. And if used
Hmm.
incorrectly or inappropriately, they're not that great.
Yeah.
And most of those things that make them not great or are used incorrectly have to do with personal choices on the part of the investor, just like everything else.
Right. Personal choices and the understanding of what you're
Yes.
actually investing in, right?
Yes. Yeah. So I thought we should discuss it and kind of clear the air because I do find them to be a useful tool. I know you do too.
For
Um,
sure.
they fall into that group of things that I don't mind using if I'm talking to somebody I may never see again.
Yep.
If I know that I helped them find the right target date fund in their retirement plan, they're going to be okay.
Yeah.
It may not be perfect,
Yep.
but it's going to be okay.
Right. Yeah. Exactly. And you're going to get into a lot less trouble by doing that than trying to like
Well, build a
select some
portfolio and then not
portfolios and
see
then
them
forget
again.
about it. Yeah.
Right. So, that's as a practitioner, the bottom line is sometimes you can't let the perfect be the enemy of the good, right?
Right.
And
Well, and we all have this as advisors. We all think we're,
oh,
smarter or have the best
yeah.
portfolios. And like, so, sometimes as a result of that, you'll see people trash, other things out there to make themselves
Well,
look better. And it's not necessarily the case.
yeah, there's plenty of folks in our industry that still view their value as building a portfolio.
Right.
While we do that, we don't see that as the most important thing we do.
Right. Absolutely. Absolutely. So, how do we define a target date fund? What's the makeup? What does it look like?
I think the easiest way to talk about them is they're meant to be a one fund solution that will
Hmm.
be appropriate for an investor who plans to retire and use the funds sometime around the date that is in the name of the fund.
Right. Yep.
So we're coming up on 2025. If you're planning to retire in 2025, the appropriate fund for you would be the 2025 version.
Yes.
And if you are retiring in 2040, it would be the 2040 version.
Yeah.
And the idea is that the further out from retirement you are, the more risk the fund's going to take, the more stock
Hmm.
oriented the fund will be because you've got time to make up losses and take advantage of long term returns. And as you get closer to retirement, they have what's called a glide path where they
Hmm.
glide the allocation down to something more conservative right around retirement.
Yeah, I kind of chuckled when you were saying, explaining how you should like choose the appropriate year, but I chuckled because I've seen it
Well,
before, right? I've seen
yeah,
people who wanted to retire in 2030 and they had a 2050 retirement fund, and to couple that, they had a
yes,
2025 fund.
yes,
Like,
yes. That is not what we mean when we talk about being diversified.
yes.
I guess if you're not sure when you're going to retire, it's one way to cover your options. And
Yeah.
I have seen people, I kind of chuckle at this too because it's putting too fine a point on it. But I've seen people that would say put half their money in the 2035 fund and half their money in the 2040 fund because they think they're going to retire in 2037.
Right. Yeah.
you know, which sure, okay, okay,
Well, and that's one of the drawbacks is usually you're only getting 5-year increments, right?
right.
So it's not,
Well,
it's not like super multi-targeted, but honestly, in
Right.
the grand scheme of things, that
It's
5 year window is a pretty minor detail.
yeah, it's going to get you close. It's going to
Yeah,
get you close. So, as with so many things, there's pros and cons, and we should just talk about what those pros and cons are, right?
yeah, for sure. So I think the first one on our list is simplicity,
Yeah,
right? Like you don't have to worry about what funds you should own or what kind of mix, because the fund itself and the managers of that fund are going to take that all into an account and build
right.
the appropriate portfolio.
Right. So we've talked about risk tolerance off and on over the years, right? And one thing that um, the psychologists who work in financial planning and investments have shown us is that investor confidence is an important part of risk tolerance.
Right,
So it's one of the few things that can be improved, or that someone can take action on and
right,
change. If you're a conservative investor and you get emotional about the markets, you're probably not going to change that.
right.
But if part of your problem with the markets is lack of confidence, well, sometimes simplifying and not having to deal with eight different decisions helps you get past that.
Yeah, for sure.
So so I think that's one of the keys.
Yep. Well, and
Um,
another thing that when we went over our investment philosophy, we talked about, but it takes out the rebalancing decision, right? You have
mhm.
one fund and the fund manager's doing all the rebalancing for you. So,
Yeah, you don't have to worry about that. You don't have to think about how much goes in emerging markets versus short-term bonds versus
right.
developed international. You're
Yeah.
basically saying Vanguard or State Street or whomever is in charge of this fund, they're going to be much smarter about that than me, and
Yep.
I'm going to trust them to do a good job.
Well, that's one of our other pros is diversification, right?
Right, right. These these tend to be very diversified, covering the
Yeah.
entire market.
Yeah. Which, and you can purchase a target date fund in, any account that you want to. Where we most
Hmm.
commonly see them though is in 401k or retirement plans.
Right,
And the
403bs,
benefit
401ks.
of them in a 401k is that they are so well diversified. There's things in there that you can't go to the plan and find a fun solution for.
Right, yeah, and that's a good point. Sometimes when we've wanted to come up with more creative solutions, a lot of times the things that we would like to include per our investment philosophy aren't available in the 401k plan
Right.
unless you use a target date fund where
Yeah.
it's just a sliver of it's not available. There's no emerging market fund, or there's no
Right.
international bond fund, or small cap value fund. So um, yeah.
Yeah, so and that's by design. We've talked about it a little bit, but 401k plans are designed to be kind of simple, and which is why they don't have 100 different fund choices in them for the most part. Um, so, and for good reason, they did a lot of research on the fact that the more fund choices that you have available in plans, the less likely people are good to choose any fund or to participate.
Right.
And so that's where a target date fund can really be useful depending on the plan design. Another thing along those lines in our pros column is they tend to be inexpensive, um, which is a good thing. A lot of times when we're looking at these 401k plans for clients, the target date funds tend to be pretty inexpensive, and then they have more expensive
Right.
actively managed funds, and so that plays a role in all this too.
Right. A lot of and it comes down to the funds that are making up the choices inside the target date funds. So
Right.
you got to kind of be nerdy and look under the hood to really get this information. But a lot of the ones that we're seeing lately are based on index funds and tend to
Hmm.
be relatively inexpensive, which we like to see because we've talked about that before. That's the number one
Yeah.
driver in the long term of how you do compared to the markets.
Yep. Yeah. And, we see a lot of Vanguards and State Streets and plans, and those tend to be very
Yeah, Fidelity
inexpensive.
Index
Yep.
based
Yeah.
options. Yeah. Yeah.
Then
All
the
right.
last one on our pros list was automatic. You want to talk about that a little bit, Dave?
Well, yeah, you don't have to ever be concerned about, oh, is this a good time to put money into this stock fund vis-a-vis the
Mm,
bond funds in it that I've chosen?
right.
You don't have to think about, do I put 30% in this and 40% in that? You just put 100% into that target date fund. Your money's going to automatically be invested in that fund. As you mentioned a few minutes ago, inside that fund, the managers are rebalancing it for you every quarter if it needs to be
Hmm.
rebalanced. You really don't have to do anything other than set it up and contribute your
Yep.
money.
Yeah.
I
Yeah.
like that. The fewer decisions we have to make, and this isn't a professional versus amateur thing, just in
Right.
general in your life, the fewer decisions you have to make, the less room you have for
Hmm.
mistakes, right?
Well, and it's interesting because if you look at like behavioral finance, like the most important things that you can do and control are setting it up and contributing money, right? So if
Right,
you want to
right,
outsource all that other stuff to a target date fund, chances are in 20 years when you're ready to retire, you're going to be in a pretty good spot if you did the right contribution amounts and that kind
right.
of thing. We talked about the pros, but as always, there's pros and cons to every decision and every, financial product, if you will. So, what are some of the cons, Dave?
Well, they are one size fits all,
Hmm.
really.
Yep.
You're basically providing one data point to the
Right.
managers. I'm planning to retire in 2040, so invest my money accordingly.
Yeah.
And that's not a perfect science. What
Right.
they and this because we've looked at target date funds from across the industry from different fund managers, and they're all a little bit different, right?
Right.
So how Vanguard is going to decide what's appropriate for somebody who invests in 2040, and how Fidelity decides it should be set up for somebody who's going to retire in 2040 may be a little bit different. Probably
Right.
not. They fall into the category of ask me in 20 years which one was better.
Right.
But it isn't perfect. It is one aspect. And that kind of speaks to what I had an issue with in that article originally, is that people were shocked to find out that if they had a 2020 target date fund, it still went down in value during COVID.
Right.
Um, and these were professional advisors that were, kind of taking that position, which is what
Hmm.
really got me, to think we needed to talk about this. Um,
Uh,
so that, but that's that, but that risk tolerance piece is still individual, right?
right.
And
Hmm.
if you have a problem with risk in general in your investments, do not assume that the risk that you perceive is going to be the same as what that fund manager perceives, because they
Right.
don't know you and they're being objective, and they're saying, okay, but if you're retiring in 2025, you're probably still need to be 50% or so in stock, because
Right.
you've likely got 30 or so years ahead of you to draw from this fund, and we need to beat inflation. They are
Yep.
not looking at it and saying, oh gosh, you can't handle any market volatility because you're about to retire.
Right.
And if that is you, then target date funds are not likely to be a good fit.
Yeah, I mean, it's basically assuming that every single person is going to have, the same risk tolerance, the same reactions to the market, the
Right,
same willingness to stick it out, and just kind of lumping everybody in and saying, okay, this is what, the perfect solution for you, which just isn't reality and it isn't true,
right,
right? And that's where we see people get into trouble with target date funds is
right,
not understanding what exactly that means or how your money's being
right.
invested as a result of that.
Some other things on the con side. Um, if you have the resources and the knowledge
Hmm.
and aren't limited by the choices in your plan, you could potentially do better. you
Yeah.
know um,
Mhm.
and when we invest our clients money, we don't do it exactly the way Vanguard would do it in their target date fund for
Right.
that particular investor. We have our own take on what's appropriate, um, and hopefully have the tools available in terms of fund options to implement it. So we're not I certainly wouldn't argue that these are the best answer for everyone.
Right. For sure. Well, and it's interesting when you say do better,
Well,
right? I mean, I
yeah,
think everybody like
it begs the
automatically
question.
assumes that we're going to outperform, right?
Right,
And the reality is, do better means a lot of different things to different people, right? Like, so
hmm,
a portfolio customized to your risk tolerance, your retirement goals. The other thing about the target date is you might retire in 2030, but you might not be planning on using funds from your retirement until 2040, right?
We run
Like,
into that a lot, right? Right. Where if they've got after tax money, it may be better to leave the 401k money. There's
right.
there's all kinds of nuances to that. No,
Yeah.
you're absolutely right.
Yep. And so, another con on our list is there is some inflexibility regarding the glide path, right? And so,
Hmm.
what I mean by that is, as you get closer to retirement, by prospectus, the fund company is automatically going to start de risking, right? Like they lay it out for you. You can tell exactly when these changes are going to happen. And it takes, it doesn't take into account what's going on in the market, and you do get into these situations when you are forced to sell low and buy high as a result of that, where maybe a more customized approach, you would dollar cost average into those changes, or wait 6 months and see how things turn around, to make some of those decisions and changes. So
Yeah, yeah, and or dollar cost average into those changes if that makes sense, depending on what the markets are doing.
right.
Yeah.
Yep. And then let's see. The last one of the last cons is trusting the fund company's idea of what's appropriate. Want to comment on that, Dave?
Well, it's another way of talking about it being just a single data point, and
Mhm.
that all you've really told them is your target date, and they're going to then do what they feel is appropriate.
Right. Well, and the other thing about that is most fund companies that are putting together a target date fund are selecting their own funds.
Yeah, that's
Right.
that's another good point too. Yeah, if you buy the Vanguard target date fund, it is going to be made up of Vanguard funds. If you buy the Fidelity target retirement funds, it's going to be built on Fidelity funds.
Yep. And that, it's not to say that it aren't good funds underlying, but you don't have the ability to potentially find what it might be a better solution for that particular
Right,
part of the portfolio that you're trying to put together. So,
right.
and the last one, we talked about this a little bit, but just because you have a target retirement date fund, you're still going to have risk, right? So how does that play into
Exactly.
things?
Yeah. So I think that's kind of the big thing that well, it's the big thing that drove us to want to record this in the first place.
Right.
But when we look at, I think looking at a concrete example might be a good way to go.
Mm-hmm.
I've got it in front of me here, and we can link this in the show notes. But the target I'm using Vanguard because it's pretty ubiquitous throughout. We see them a lot. The
Mm-hmm.
Vanguard Target Date 2025 fund, in 2022, so the year before last, when the markets were correcting because inflation had spiked and we saw both bonds and stocks do so horribly, that fund was down 15%, 15 and a
Right.
half actually.
Mm-hmm.
And so, if that was for a conservative investor, that might have been a shock that 2.5, 3 years out from, you know, this date when I'm supposed to be able to leave work,
Right.
my retirement fund is down 15%. Now,
Yeah.
it was then up 14 and a half the second next year, and it's up 7.5% so far this year.
Mm-hmm.
So it kind of does illustrate the point that usually those kind of drops are short lived.
Right.
Um, but you've got to be ready for that. And that's an allocation that at this point, so that Vanguard allocation, here we are a year out from retirement, is still 51, about 51.5% in stock.
Yeah. Mm-hmm.
So, they're not anticipating that you take no risk as you get close to retirement.
Well, I think that's, the big problem is, and, we see this a lot in terms of when there's kind of the most chaos going on is when people make the worst financial decisions. And not that retiring
Absolutely.
is chaos, but there's a lot of emotions around it, right?
Mhm.
And so you have this situation where you think you have a safe investment and you're getting ready to retire, and all of a sudden it's down 15%, right? Like,
Right.
then the real risk there is you don't, you react to that, you take it out, you put
Yeah.
it in cash or something else, and then you don't get
And
that
you don't get
recovery,
the
right?
recovery. Yeah, absolutely.
So,
Absolutely. And
another problem with those types of funds is not only understanding the risk, but also like, who are you calling when it's down 15% to figure out what's
yeah.
going on?
Yeah. Is this substituting for hiring an advisor?
Right. Exactly.
And, that kind of boils down to where we would leave off, is if you're not ever going to see an advisor, target date funds probably are a good choice depending on your plan. But actually building a financial plan, talking through your goals, what is your actual risk tolerance, and then getting that behavioral coaching when
Right.
things do go bad, so that you don't make those fatal errors. You know, we talk
Yeah.
about we talk about risk tolerance when what we really mean is volatility tolerance.
Hmm.
Because if it was about risk, what's your bigger risk? Having it be up and down in the short run and, compounding at 7% or so, or whatever a 60/40 has done over the last, God, how many years,
Right.
or invest or moving it all to cash and performing less than inflation.
Yeah.
So,
Yep. Like as you like to say, there's no free lunches, right?
no.
So like the best thing to do is understand the risks, and like we said, I think that's a lot of what gets misconstrued here is there's going to be risks no matter what you do, and there's risks in these funds, and the people that are successful investing in target date funds are really investing at all, understand what those risks are. They prepare themselves for the inevitable, right? Another thing we like to say
Hmm.
around here is I, our only guarantee is that stocks are going to go up and they're
Yeah.
going to go down. So
Yeah.
be prepared for both, right?
Do the lifeboat drills. Yep.
But also, if you do have a professional advisor that can kind of hone in on what your retirement's going to look like, when you're going to need to use those investments, how that's all going to play out, you can create a customized portfolio that's going to better suit to you and all of your needs and all of your data points rather than just, picking the date that you want to retire and assuming that everything is going to be fine.
Absolutely. It's a
So,
good way to sum it up.
well, thank you, sir. This has been wonderful. Appreciate the time. If our listeners have any questions on retirement portfolios, feel free to reach out to us at info@srbadvisors.com. We would love to chat. Dave, as always, been a pleasure.
Thanks, Nick.
This is a Zedia Media production.